FOMC, non-farm payrolls, and the underpricing of risk. Hey gang, it's time for another weekly outlook of markets and profile from the team here at TRADEWITHPROFILE.com as part of our profile trading development pathway. This is where we start every week to get a plan for the week ahead. And so even if you're looking for ideas and looking to express risk in an intraday time frame, it's good to have a plan for the whole week to know where those larger areas of interest are, larger references, larger catalysts, so that you're not caught off guard when those come in play. By the way, my name's Josh. I'm the founder of Trade with Profile. We are a skill development firm for traders who are looking to build their foundational understanding of the auction process and pair that with a playbook so that they can be consistent. And we use the profile as the key input to help us organize the auction information so that we make better decisions. And it's our conviction that if we make better decisions, we'll take more profits. So with that, let's jump in with where we like to start, and that is kind of getting a macro perspective of what's in play. Now, you can get really crazy with macro narrative, and I see this a lot with people who are wanting to get all involved in like what's the macro dynamic. Think macro as just it's a context. It's a context for what's going on, and the macro narrative shifts. Right now, the narrative continues to be inflation and the Fed's fight against that, with the added kind of political spin that we got midterms coming up, and we've got this FOMC in place. So how do we translate that into something that we can actually use? And this is where I go to this tool. So this is looking at the ES relative to the VIX curve. And the VIX curve, really simply, is just a measurement between how are participants pricing risk premium relative to their portfolio. And it built on a very solid principle, and that is that markets rally when everybody's too bearish and they fall when everybody's too complacent. Okay, so this gives me a visual to be able to see that. And what we can see here is there's kind of two zones. So let's call this more the overpriced risk zone, and this is the underpriced risk zone. So we're in the middle of that. We came off of a overpricing of risk, and that was off of the last CPI we had a couple weeks ago that got us down to that 2022 low. You can't see that here because this is actually just the RTH session, but that was a low. We were very bearish into that, and now we're burning off. The technical term is that we're in this large Vanna rally as we're burning off risk premium from puts that were either not rolled and not monetized and not new puts being bought. So that creates a condition, a feedback loop that leads us higher as dealers are buying back inventory against that, and they're taking back to prior inventory levels. Where are those? We knew those in the profile, 3,900 and 4,150. 4150, very key. We're going to talk more about that when we look at the ES as far as that's kind of the most traded price of the year. That was also the scene of Jackson Hole. We've been there a couple times, and that's been kind of a key price. I think even at this point, I don't believe that we're going to be able to shift the most traded price of the year anywhere else. I think it's going to likely be there. Could possibly be 3,900, but most likely 4,150, and carry that in to 2022. So as we go into the week ahead, we know we've got FOMC on Wednesday. We got non-farm payrolls on Friday. Everybody's expecting the Fed to pivot. So essentially what we're doing is we're pricing in a pivot. But what this does set the condition for, and something that we're going to be watching, is that if we go into that event and we have underpriced risk and we burn off more of these puts, then that puts us in a place where you can't really burn lower. So then if you continue to go higher, then that's going to bring in the counter response and take us back down for the next leg, likely into that CPI or the uncertainty of midterm elections. At the same time, kind of the macro dynamic that's in play that's keeping us in a pretty volatile space is the strength of the US dollar relative to other world currencies. And so, that's why things are really struggling to get a bottom. It's why I'm not really convicted that we have the bottom yet, because there's still a lot of upheaval happening, not just in the US, but globally. So that's kind of the macro narrative. Now, the next place that we kind of go looking for the week through to start the week is to look at the calendar, look at specific catalysts there. You can find this on the TWT website. What do we got? We've got GDP and CPI coming out of Europe on Monday. That's going to be pre-open, likely going to give us some movement. Be aware of that. Tuesday, we have ISM manufacturing at B period. So be very careful if you're active in the first half hour. That number is going to come out. That's inflation related. So whether something's a core inflation number or not, we're finding that inflation related things or things that give us an insight into the inflation story are moving the markets. So be watching that one. And then, of course, on Wednesday, we have the Fed's interest rate decision. That's typically a non-activity day for us. We get 8 of those a year. It's a great time to show that you are not, in some sense, addicted to the markets, that you can have the markets running and not be in front of them. It's a great time to go look at other things. Typically on an FOMC day, we see a little bit of directional excursion early, and then the auction quickly goes to balance in anticipation of the actual release. And then Powell will do his press conference till the end of the session, really not making the auction very active. It's better to come in on Thursday after that. So that's happening on Wednesday, and it's all going to be about, do they pivot or not? Right now, they're still expected to raise rates. Again, just maybe not as much. And how this kind of works, expect the first knee-jerk reaction to be higher if it's as expected or less. Okay? It would only be if they went higher than the expectation. And if you want to know kind of what the expectation is, you can always go to the CME's FedWatch tool and find out, to the minute based on the Fed Fund Futures, what the probability is that we're going to do. And right now, still 95% chance that we're going to do a hike. Okay, Thursday, we've got imports, exports, jobless claims, all that pre-open, a little bit right after the open. So a whole bunch of chunky stuff. I'd be really careful Thursday, really through the IB. Maybe wait until after the IB on Thursday, given there's a whole bunch of inputs there. And then on Friday, we have the non-farm payrolls report. So that wraps up the week. That's important in the narrative right now, because one of the things that the Fed is starting to look for is their activity starting to hit the job market. That would be a sign that they are putting enough pressure on that they could pull off. We haven't really seen that yet. We still have had pretty healthy pre-pandemic type job reports. And so, it's kind of hard to compare month to month because there's seasonality in jobs, but we'll just see if they come in relative to the expectation or not, and see some softening there in the data from the Bureau of Labor Statistics. Okay, with that, let's start digging into specific products. And we're going to start by looking at the S&P, okay? And one of the things that I want to start with the S&P, just as a review last week, is to take a look here at the expected range from the quick sheet relative to how we traded. So, expected range, we calculate that quick sheet is here. We're gonna look at it here just a second. That's available as a download to this link to this video. But what this illustrates is how predictive we can be about where the auction is going to go. We'll get this when we talk about the other products as well. But the expected move, which is based off of Black-Scholes formula, gives us basically a 1 sigma or 1 standard deviation move for the week. And so, 9 times out of 10, we're going to close. 7 times out of 10, we're going to close inside that range. We spent most of the week in that range and then got out of it at the close. So that was really fascinating, to say the least, in terms of how we were acting. Now, let's go actually look at the chart and get a sense of just kind of like where are we headed, where are the likely destinations, what's going on. We're looking at a monthly profile here. These lines are old CPI ranges, so we're just kind of knowing that that's been the dynamic. Those are the ranges that we're moving. Those are the ranges of the first 30 seconds after those CPI readings. Where are we for the month? New monthly highs, very strong move higher on Friday. Note that it was about average volume. The last two have been very significant high volume. So we had high volume to start the week, low volume in this last push, but where's the destination or the path of least resistance? And that, my friends, is up here. So 39.65, expect that to hit, and then for the auction to kind of rotate around that. Why is that? Because when we come into an area of inventory like that, the auction is likely to pause. So you can see the weekly expected high here at 40.32, the weekly expected low at 37.90, based on where we are from a posture standpoint, the 5-day here at 38.50. Looking for at least initially higher prices this week to start. If we go straight up here to 38.50, I will likely look for some type of responsive activity back lower, or sideways, as the auction will have to pull value higher. We now have some decent separation between the 5-day and the 20-day. 38.44 will be our key price that we're looking for, and also noting that we hit our key target higher was 38.75 last week. Our key target higher this week is 39.50. and or 39.60 could go and traverse to the other side of this CPI range. That would not be unusual. So we'll look at that. But as we look at the weekly chart here, you can see how, really strong impulsive move, starting to run out of inventory. This magnet is pulling us. That is the path of least resistance. We are out here above 2 standard deviations of the monthly VWAP, and we closed above the weekly. Very, very strong move here, holding kind of the month to date, what we call the trending channel from an anchored VWAP perspective. So if we open Monday, based on the trend day on Friday, look for some rotations or initial higher prices and then back and rotate. But ultimately, we're looking for a move up here. If we go up here first, then look for responsive activity back lower. And if we end up at 38.50, that could be a post FOMC thing. If we're below 38.50 post FOMC, we'll go. If we push above this pre FOMC, look for us to push back in this direction. But keep an eye again on those expected highs. So this is the range that this week that we're likely to play in. So what are the key references? 38.50, 39.67, kind of 40.50 are the areas to watch. Okay. Looking really quick here at the profile from Friday, very, very impulsive, imbalanced to the upside and this was after Apple and Amazon earnings. You can see the auction moved below the 5-day and then back above it. This is something to be expected. Is if you push below a composite reference and come back to it very quickly, the auction knows it can't go lower. Off to the races. There are some other mechanics about that we'll talk about in a little bit, but right now higher. So for Monday, with halfway back here, we'd expect rotations kind of in this area in an attempt to build some more value here. So if we're immediately higher, look for responsive activity this way. If we open in range, day after trend opportunity for new RTH ranges, and then rotations as well, as we're a bit stretched. Okay. If we got below 38.65, we could cause a little bit more concern, but that's what we're looking for there. Again, just from the quick sheet, looking at the expected ranges that we're looking for this week, 77 points for a session. 172 for the week. That is at 40.32 and 37.90. We've got a new posture, price equal to the 5-day. So that makes that 5-day, that 38.45, pretty key to the auction as we go along. Okay. All right. Now on to the NASDAQ as we do. And also driven by what was happening with big tech earnings. We actually see this when we go and look at the monthly chart. Big move. Really, really insightful how the auction moved off of the Apple earnings down here to the 20-day. Tested below, paused, but held that reference. Tested actually the top of the last CPI range. Came back above, went back to the 5-day. So we just played ping pong between the composite references, but closed up near the high. We have, I would say, a poor high here. So we're definitely expecting new highs this week and looking toward. We've got a node here at 1812 or 812 back towards this balancing area up here with the magnet of kind of the 90-day 12,200 above us. Looking at that on a weekly basis, not as stretched in the NASDAQ as the ES is, just because of how far we went lower before we went higher. So that is. Kind of lost some prices there. We're up here. Weekly expected high gets us up into that area where that key reference is. So looking for the 90-day 12 to 20. That's also the 2022 VPOC. We could get up there. That does have some potential. Looking here at the TPO chart, very impulsive. It was not able to make new weekly highs, not that far above the 5-day. So definitely the 5-day and last week's VPOC is going to be important to the auction. On Monday, can push toward new weekly highs. I would expect a gap higher to start. Watch. That's led by couple of ideas. One, we have an imbalance here in the profile with some skew. Would expect that to follow out. that gets us up here to get to a bell curve. So if we're higher, we could gap and run. That could happen. Be mindful of that. But if the gap fails, it's going to be right back down here to this 11.56 or 7.5 level. If we get inside, we could do a little bit of cleanup. If we open inside range, look for a test back down to the 5-day and then up for new RTH highs. That's what we call a day after trend trade. But ultimately for the week, looking for, kind of up to the 11,200 or the 12,000 area. If we go directly higher and then see if we can pull value lower or come back in that direction. So path of least resistance, at least into FOMC, is to the upside. And then we'll see after that. The expected range, again, here, 530 points. You can see weekly expected high, 11,958. I think we could push a little bit beyond that, get that 12K, and then the 11,215, because we've got the 90-day at 12,213. That's not that far away. That's really pretty close. We could stretch and get there, so we'll just have to be careful about that as we go. Same deal with the NASDAQ as with the ES. Here was the expected range. Here, look at this. We actually traded to the edges of that range and stayed inside of it. So when people say, hey, it's an expected range, is that actually predictive? Mm-hmm. It is. It is, because it's based on where people are pricing options. So that means there's positions there and there's some defense there. There's response around that. So that is always insightful to see as we're looking to make decisions. It tells us it's something that we can lean on as we're looking to make decisions. Okay, now let's go back over here to the Russell. And where we got on the Russell, we got new monthly highs. We're back into a CPI range. We had to move away from balance and looking, it appears, for our year-to-date VWAP. That seems to be the path of least resistance. So we're expecting the Russell to get up there and potentially exceed that. We do have 1908 as the weekly expected high, but my key target is up here. If we pause, stay above Friday's low, anything balancing here, I think, is an opportunity to get long for that year-to-date VWAP. If we run right up there, I don't see anything stopping us, gang. So, on the way up there, if we go straight there, then we could see if that gives us a reaction like it has before, where we've pushed up into that year-to-date VWAP and then come back down. If we go up there, you'll notice that will then likely stretch the profile and actually put us in what we call an extreme posture, because we'll expect the 5-day to migrate here as we lose days and add days. The 20-day will be here, so that'll put us in an extreme posture. We'll look for the auction to at least trade sideways or back lower. And so if that all lines up with FOMC, expect that to be in play. Again, started with some pretty good punch from a relative volume perspective, and then decent volume, but the last punch was low volume. So we're starting to get back to a spot where we're running out of juice. And that's one of the things that we talk about in understanding, when might we anticipate an auction starting to run out of steam. We can see that in structure. We can see that in volume. Double distribution trend day on Friday. As long as we're in the upper distribution, so above 1840, we'd look for 1865 on the way to the year-to-date VWAP. Daily expected high up here at 1875. So really the field of play is expected to be here. We could clean up some of these singles and get down toward, the node here that is at 1828. We'll have to see. If we open in range, look for early responsive selling and then, buyers to step in so that we can get new highs. If we open above range, if we fail, we're coming right back down here to that VPOC, below that to this decision level and some rotation based on what's happening on the composite. Okay. So pretty cool, but expecting, up and to the right. Just like the other products, the Russell expected range. Now we pushed outside of that. So we got more than a 1 sigma move in the Russell, but you can see how those ranges do actually impact what's happening in the auction. It's very, very insightful in terms of what we have in terms of expectations. But all in all, saw higher prices that we expected in all of the equities. And with that, let's now go take a look at crude oil and get a sense for what's happening there. The expectation this week was that we would get up to that $88 spot if we could get above, prior week's VPOC and move. So we are now there. We're back to balance on a number of time frames. So, can definitely chop in this area for a bit and see, but as long as we continue to hold this, that puts us on a path toward that year-to-date VPOC up there around 92.50. I don't think we get there this week, but definitely is in play. Looking here at the weekly profile, we've got an imbalance to the upside. What do I mean by that? Here is the most traded price. So that would put us in this direction, which theoretically could get us to that year-to-date VPOC. That is the weekly expected high. So we'll have to see and watch that. Definitely the key defense is going to be this zone from 88, let's call it $88 to $89. So expect chop there. If we push lower early, a couple places to watch defense is where this buying came in, big RVol. So, which was the top. This was actually the EIA movement. We were in this 83 to 86 range for quite some time, and we were expecting a break out of there to get to 88. That's what happened. So now we're at this destination. As long as we hold here, we know where the next ultimate destination is. Notice that there are some holes in the composite. So these low volume areas, as we go and test them. So, like kind of first destination would be to test this poor high. Above that, we could pause at this high volume node and then back off. And then if we punch through that into this low volume area and back off, and then on to the key reference up there. But definitely looking for the auction, as long as it holds in this section area, to push here and make new weekly highs. And then we'll see if they start to rotate. But we've got imbalance to the upside, bullish, as long as we're above that 88 to 89 zone. Below that, and if we fail, that does put us on the path towards 85. Okay, so we'll kind of look at the 88, 89, kind of pivot, a little bit neutral in crude now that we've achieved that. To the upside, 92.50. To the downside, 85. Okay, that's what we're looking for there. From the quick sheet here, let's just go down to look at the ranges. So we're balanced. It says we're above the 20-day, but we're pretty much there. The 20-day is closer than where it is, so it's going to rotate up. Expecting $2.76 a day. We have seen, this shrink. Notice that the implied volatility percentile. So this is volatility relative to itself over the last 52 weeks. So we're pretty low volatility from what crude has been for the last year. So we're starting to see the ranges come back to, $1.50, $1.25. It's not the $4 ranges that we've been seeing. So that's good. So it's a little bit more tradable as we're looking to express some ideas in that. Okay. All right. So that takes care of what we're looking for there. Let's talk about some other ideas that are in focus and that are on the radar. And we're start by just kind of doing, we started this last week, but just kind of looking at an update of some active ideas we're seeing in the quick sheet, and also from our partner in equities, MeFlow, and just talking about those and where those are. So a couple, we'll talk about the active ideas in a second. Just a refresh on ones that we talked about last week that are still in play. So one of them that has been put on through the week was a double diagonal in Boeing. That was after, that was on earnings there, basically looking to arbitrage the volatility out of that one. Still long via the short 35.50 put in ES. That's looking great. We had kind of three different double diagonals that we were looking for in like Apple, Microsoft, Google. Ended up taking the one at Microsoft. Still in that one. We'll look to close that one, probably Monday or Tuesday. Still short the 1060 put. That's looking great. Got a little bit of heat on that one post the Apple earnings, but as we got back, that worked out great. Didn't put that in place. I've covered most of that iron condor at the 120, so I'm letting the rest of it kind of roll. Still in the copper gold relative spread, and then the stock stuff is longer term. I'm not really looking to do much to that until we get past the Fed stuff. Okay, active ideas that we're looking for this week. I just want to kind of go through and refresh those. Let's start with the Bitcoin one. I like blockchain. I like Bitcoin. I don't like the fact that we don't have a good low here. So we are and have been for some time holding in this high volume node. I'm looking for a test, a really solid liquidation test, and then back in here, and then a push to 30K. Okay, so while we bounce here, I'm really not interested staying on the sidelines for that one. Okay. The next one is Colgate. They just reported earnings on Friday, and they are now, we'll go to a 4-hour chart here. They are now kind of coming back to some, high volume nodes with the implied volatility off of that. I'm essentially looking to do a post earnings strangle here in a range, kind of this low to here, and kind of stay in that the next several weeks. So I'll be looking to put that on Monday if it is advantageous to do so. Micron, straddle, okay? Looking for this one. Now, Micron doesn't have earnings for a couple weeks, but if you look here, you'll see that they're right around this 54 node, and they're in a tight range. But I think this is tradable. So the implied volatility is small enough. It hasn't increased so much going into earnings yet. So this is actually pretty great. I expect it to increase, but I'm expecting Micron to at least test the sides of this range. So I look to put it on if we open at 54 and take it off at either a test of 57 or 49 in the next couple weeks. So we'll price that one out beyond that, looking for that one. And then finally gold, that showed up on the quick sheet, and Friday, directional trade off of a composite node, looking for follow through and new lows here. So looking for balance or something to be short. You could do this via at the money debit put spread. To be short down here would be wrong back above 1650, but at least here target 1, and then 1600 would be target 2. Okay, so those are the open ideas, and new ideas we'll have. We'll kind of follow those along and see where we are and which other ones we add to that as we get into the week ahead. Okay, so those are some ideas and focus to pay attention to as we get into the week. Finally, some development focus. We take some time each week, because we are a development firm, to talk about how to just approach this game with more skill. And the one that we're talking about as a team, and I think is important to grasp for those of you who are trying to eke this out on your own. And to that end, I got to say, in the attempt and desire to build your approach on your own, I know there's gads of resources out there. Just remember, you're going to pay for your education one way or the other. You will either pay for it in actually investing in it, like if you went to school for any other profession, or you'll pay for it via opportunity cost. Because I believe so many of you are smart enough, you'll figure this out eventually. Just how much time do you spend not taking alpha out of the market to get there? How many things are you having to unlearn? Every day that I have a one-on-one insight session with a developing trader, I hear about all the things that they've learned that they have to unlearn. Okay, that's opportunity cost to your approach. So if nothing else, pay attention to these development focuses, because we're trying to give you some grit under the tires that you can lean on. So the theme, if you can make it here, you can make it anywhere. What do I mean by that? Well, we have some unique things happening in markets. Now, there are things in markets that never change, and there are things in markets that do change. And what we're seeing right now that's new is we're seeing a lot of movement. And it's funny that there's green in this image, and so it's taking it out. But let me... essentially what this is showing is the left column is 0 to 1 days to expiration options. So the intraday option volume by expiration is heavily skewed to 0 DTE options expiration. In fact, we can see that here in how this is relative to history. Okay, the red being the 0 DTE. So what we're seeing is an explosion in near dated or expiration day options, and because most of it is being purchased. Okay, so it's not being sold, it's being purchased. So because people are, hey, here's a cheap thing that I can buy, and then it will explode higher. Well, guess what, guys? The reason it explodes higher, there is a feedback in that, and what's happening is that when you buy those 0 DTE options, well, I mean, if they go lower, they just go to 0. They're easy to hedge. To the upside, they will accelerate to a degree up to 1 deltas, but then that causes the dealers to just, buy futures against that to get ahead of you. So, in that demand, it's what's driving these really, really big moves, especially on expirations. And the fact that we have 0 DTE now on the SP every day, we're seeing these wider ranges. It's also what's contributing to a decrease in liquidity in the book. And what does that mean? It means that, like in the past, like let's say I had 100 contracts. Okay, if I wanted to go and just buy 100 contracts, there was a day when I could buy 100 contracts and not move the market at all. In fact, the top of book was about 15 million. Right now, it's about 6 million in terms of what I can move. Some of that's been because of iceberg orders. Some of that's been because the S&P complex has gotten wider. It used to be just the SPX, and then there's the ES futures. Now there's the MES futures, and then there's options on the futures, and then there's the SPX options, and then there is SPY options, and then there's micro ES options, and now there's not just weeklies, but there's dailies, quarterly. So there's all different places that people can be in risk, and you can see that in this chart. Is that historically, people were in options out a month in advance. Here in the last couple of years, it's been really compacting that to be under 1 month. We're seeing a lot more interest, especially the biggest increase has been in the 0 DTE stuff. So that's why we're seeing these big moves. And unless we change the products, guess what? This is likely going to be the part going forward. Now, that's the part that's changed. And one of the things that we have to do as a developing person in this industry is we have to adapt to new things. And that's a new thing. So we're adapting to it. Okay. Now, here's what's cool is the stuff that doesn't change. And this is a chart that I posted on Twitter, and I said, hey, 3875 is calling. Why was 3875 calling? Because that was a prior composite inventory node, and that was the path of the least resistance for where the auction was. So there's a composite over here. It's a merge profile of a number of days. On the far right, that is one specific day that we're pushing up to that. And then notice that we got it and immediately had a responsive move off of that. This is very natural behavior for the auction when it gets back to prior inventory like that. So this is a part of the auction that hasn't changed. Okay, so in your skill development, you're looking for the things that have changed, adapt to those, and things that haven't changed. And this is why it's really important to work with practitioners, work alongside those that have been in markets long enough, who understand the stuff that hasn't changed, but are also nimble enough and innovative enough to adapt to the things that have. Last number of years, I would have never done 0 DTE stuff, and I'm looking at some of it because it can be a way to have the same exposure as a outright contract, but a little bit less cost. So there's some attractiveness to it. And if you're not great at putting stops in, you basically put in an effective stop on you. So it's just, if you don't get out by the end of the day, you lose everything. But that, hey, that's the thing altogether. All of this is related to what we talk about in the pathway around specifically module 2 and using auction sessions to find better times to be active. There are auction sessions within the day. There's micro sessions. There's sessions within a week. There are sessions within the year. And then there are macro sessions. From the top of the year, we talked about that we are in a transition from a monetary market into a fiscal market, where we're not getting the Fed support that we had before. We are now in all of that and that uncertainty with the influx of new products that are spreading the book and causing big movement. Okay. So, hey, cool. Lots of fun. But it does mean that you got to be better than maybe in the past of identifying and waiting for those big references. So don't try to front run those. You'll get them. We're seeing, those expected ranges, which, hey, that's the other part of this is going back and thinking about those expected ranges. Even with all of this, we're still playing in that sandbox. Why? Because an expected range takes into account what's happening in a 30 days or less perspective. Okay. So it's taking into account those. That's why it's still helpful to look at what the expected range is. So, look at that on the quick sheet, and, for those of you who are working with us in the pathway, look at that every day on the plan to know where those expected daily highs and daily lows are. 7 times out of 10, it's going to hold, but we can push those. All right. Awesome. A couple questions to be thinking about as it comes to those for yourself. What new dynamics are there in the auction? What are they? How will you know? Second, what hasn't changed? What are the things that haven't changed that you can carry forward? How will I adapt to what has changed? So aside from what's happening right now, but going forward, I mean, what could change and how you will adapt to that? I remember at one point when I was doing agricultural hedging, we live cattle traded the whole day, the same as the equities, and the liquidity was so bad, the CME came in and said, hey, we're going to change the session. And now the session is only from 7:30 to noon in mountain time, right? So 9:30 to 2. Okay. So that changed the whole dynamic. We had to adapt to it. So, what are the things that have changed, and how will you adapt, and how will I commit to that which hasn't? Meaning, how will I stay focused to the stuff that hasn't changed and know that that hasn't changed, so that I can lean on that and make good decisions. Hey guys, one of the things that hasn't changed is that to be a better investor, trader, whatever, is to be a 4-question trader. That's someone who thinks about, what's the opportunity, what's the target. Everything's defined by the target first. Then what am I willing to risk to get to that target? That's why we use like triggers. Then what would tell me that I'm right? What would tell me that I'm wrong? Rinse and repeat. Categorize those, and you got a playbook trade and that you can track. If you don't know what a 4-question trade is, want some examples, you can go check out that on the website. Other ways to build skill aside from the 4 questions are to follow us on Twitter, interact, try to be fairly engaging with you guys. You ask good questions. You can always schedule an insight session via the website on the contact form or on the link to this video. And that's, we set aside time every week to talk to developing traders and just give them some free loft in what they're approaching. If you have not yet done so, let me highly encourage you to spend a week with us. We often have people that approach us and are like, I don't know. But that's because they've experienced other development approaches that are not systematically building the understanding and then pairing the playbook with that. And one of the things I think that's really great about what we do is that you have an opportunity to like jump right in with us and dive into those pathway modules, and then see that expressed every day in these 4 core products as a way to take principle and put that into action. So if you've not done that, spend a week with us. The worst that you've lost is your time. A couple partners to be sure you check out, not compensated for this, but we just like them. And that's the charts that we show on Twitter during the week. That's from Window Trader, and then also from edgeclear.com. And then for those of you who are in the pathway, we'll see you in Slack and in our weekly development sessions. And if you're looking to understand options better, aside, you want to get out of the day-to-day stuff, want to understand options, our new venture MeFlow offers ways to understand how to do multi-leg option strategies, the same stuff that institutions have used for decades, and actually finds those best candidates for you in stocks. Hey gang, thanks for watching. Thanks for your comments, and thanks for making this a part of your weekly prep. Be careful of the underpriced risk as we march towards FOMC, and lean into the things that haven't changed in markets. Be adaptable to the things that have, and we'll see you next week. All right, peace.